Hello, this is Hall Martin with Investor Connect. Today we're here with Ryan Pollock of Iron Gate Capital. Ryan, thank you for joining us.
You're very welcome, Hall.
Well, great. I came across Iron Gate and I thought the portfolio looked very interesting. Maybe you can tell us more about Iron Gate and what it's all about, and then we'll talk a little bit more about what you guys invest in and what you do.
Sure. Iron Gate was formed by operating executives. These are men and women who have become independently wealthy by building successful enterprises and selling them. It was formed by them to deploy capital into private investments in a way that is different to a fund model and different to kind of an angel network. And it was designed to align the interests of the LP, the GP, and the operating teams that we back. It was formed about 2005, and since then we've invested in about 25 companies.
And what's your criteria? What do you look for?
For us, we dabbled in the early days in some early stage investing, and we realized that that's fraught with all kinds of danger and really is perfect for the domain of a fund, where you need to not necessarily spray and pray, but you need, just from a portfolio theory, to diversify your bets across a lot of different positions, because you're going to have to tolerate a failure rate in those investments. And for us, what we look at is we look for companies that are growing up as businesses, probably with revenues between 2 million and 20 million in run rate. For us, from an EBITDA standpoint, our companies, when we invest in them, are normally burning a little bit of cash or are close to EBITDA break even. But really what they're seeking is knowledgeable domain expert investors that can provide some working capital for them as they try to maintain a growth curve in the business. And so, we'll come in as a minority growth investor. We'll invest somewhere between $3 to $5 million on the way in, and somewhere between 5 and 10 million over the life of a deal, if it needs it, and support the teams that we invest in. So we're very hands-on investors. We don't meddle in the companies, but because we all have operating expertise, entrepreneurs like to partner with us because we know what we're talking about. We can roll our sleeves up and help them out where needed.
And I see you have Techstars as one of your portfolio companies. What's that like?
Yeah, that you have an astute eye, Hall. The Techstar program is outside of our core direct deal mandate. And what that is that some of our investors, so we serve, let me clarify this for your audience, we serve 65 families around the US and in Europe. And so these are family offices, down to kind of high net worth individuals as well, but with significant wealth. And when we find a deal to invest in, each of our investors can opt into the deal. So sort of a deal-by-deal opt-in structure. So the Techstar deal was a specific request from one of our LPs who said, hey, I want some early-stage exposure. I like what you guys are doing on the early growth side. What can you do for us? And we said to him, we're not doing early stage for you. The deal-by-deal structure doesn't tolerate early-stage failure rates. So we said, give us a couple of months and we'll come back to you with a proposition. And, we're good friends with the guys at Techstars. We've been in this community for a long time. And we believe they have built the best early stage business incubation program in the world. That's been subsequently kind of obviously validated and written about by many other people in the industry. And we put together a fund of funds program with them. So we put money into Techstar Ventures, which into their first fund, but we also put money into their Star Power Fund, which means that we have a small piece of every early stage deal that comes through the Techstars program worldwide, with a sort of cap on the money of how that Star Power Fund converts at about $3 million per each. So we felt like we were buying a high qualified index of early stage deals at probably the lowest average pre-money in the industry. Because those funds are only available to institutional LPs, it benefited our families to come through us to access those.
Right. Well, that's the ultimate in diversification, is to get a little bit of every single deal coming through, because then the numbers really do work out the way we talk about how 1 out of 10 is a home run and 2 out of 10 is a single or double, and the rest are going to go away. And now you have good exposure across the entire thing, and looks like a great team to work with as well.
Yes, they are. They're very smart, very capable people, very humble. We look at a lot of deals that come through that program because obviously our direct investing is that's kind of our bread and butter. So we look at which deals are graduating into a stage that are right for Iron Gate. And we've gotten close on a couple, but we haven't yet pulled the trigger on one.
They are early stage, aren't they? It does take a while to get there too, it seems.
They do. They do. They also get a lot of attention, a lot of those companies, and sometimes the valuations outgrow our appetite.
Yeah, they have quite a high profile out there, a good profile too. It's the best group out there from what I could tell, and probably has some great rock stars coming out of it along the way as well. So, as you work with these portfolio companies, where do you find most of the work coming? Not just Techstars, but these other ones like Smashburger and others. Where do you find you're adding the most value?
Well, it's interesting, Hall, because when we invest in these companies, they normally base common challenges. So in the first 6 to 12 months of us working with the companies, they are typically at a stage where they've proven product market fit, they're winning in the market. But really what they need to do is become more precise on their go-to-market strategy. So that means ensuring top of funnel demand gen is sufficient to maintain the growth, ensuring that sort of their mid-funnel process is robust and world-class. In other words, don't go work deals that are not great deals for you or may not close. And so it really gets as granular as what kind of pipeline coverage ratio do I have intra-quarter to hit the quarterly numbers. So we really start getting into the metrics and mechanism of growth in the business. So that's typically the first area we spend time on, because that's where companies struggle, in that they are growing, but they're often growing by default. They haven't really had enough money to institutionalize their sales and marketing efforts. And so we help them with that. Typically, fairly early on, we are evaluating and working with the finance function of the house. So, companies that grow from sort of, as I like to put it, almost, Robin Hood and his band of merry men taking pot shots at Sheriff Nottingham in the forest, kind of early stage stuff, to the Marines, you have to get more organized in every area of your business. There are more KPIs to measure and manage and monitor. And so putting the right financial framework into the company is very important. Sort of managerial accounting, KPIs, finance function, that becomes a critical piece that we focus on. And then, within about a year to two of investing, we find that we are then coaching and upskilling the CEO as they now start to scale a business that's probably 50 to 100 people. And there, it's all about their lieutenants, their ability to delegate, trust, and validate down to departments, shrink their footprint inside of the business so they're no longer doing everything, which is what early stage CEOs tend to do. And that requires some changes sometimes in the execution layer, the management layer of the business. But our preference is to sort of coach up and really partner with the CEOs and then let them make the right organizational decisions. But, we can come in and help at all levels of strategy and organizational behavior and comp and incentives and you name it.
At what stage of the company do you think that they should have a repeatable, predictable business model? They know what things cost, they know how many are going to convert and what they're going to pay for it, and they've kind of figured out that model, and it's just now a numbers game at that point. At what stage do you think startups should be at that point?
It's interesting. The sooner they can get to that point, the sooner they can control their destiny. So there isn't a right or wrong answer on that in terms of revenue size or number of people. What we have found, though, is that it's hard for us to invest in a company if elements of that equation are not already in place. So the word you said in there was sort of predictable. And that's the hard part, is how do you get it to be predictable? And honestly, that comes down to funnel management. And oftentimes early stage sales executives are normally very capable men and women, but they may enjoy sort of the opportunistic cut and thrust of proving market adoption. And that's a little different to people who are more kind of operationally minded around sales and sales execution and sales management. And so we sometimes see the sales executives, in fact, in several of our companies, they've had to be replaced and upgraded over time. And so that's something I think that our companies have in common across them. But there's a function inside of our businesses or inside of businesses that I think is sort of the key fulcrum for success in a business. And it's really getting the right product management and product marketing nexus inside the company. And so if you take that sort of deeper in the business, it's outside of the C-suite, but you really are looking at, it could be in the C-suite, I guess, but normally it's underneath that. And you're looking at people who are product centric, but they're thinking about prioritizing the roadmap, features, capabilities, competitive, sharpening the elbows, so to speak, from a product standpoint. How do they win? And then you've got people who are focusing the market, who are the categories of buyer where the value prop resonates. How do we tell our story the best? How do we price, support, kind of partner to get into the market. And if those two functions sort of back to back in a street fight are functioning well, then companies normally thrive.
Right. And also at this stage, there's always the dilemma, do I put more into sales and marketing, sell more of what I have, or do I put more into the product and make it richer, more feature rich, and go to a bigger group? And of course, there's a little bit of both, but how much do you put in one versus the other becomes the ever constant struggle. How do you handle that?
That is a classic dilemma and conundrum. And it's, again, from an Iron Gate perspective, we don't like to take on too much product risk. In other words, we're not going to invest in a company where they are still building the aeroplane in flight, and there's a lot of risk that it may crash. Now, we are going to invest in companies that will require constant product refinements, and there, I guess in early stage venture, Hall, it's probably a little bit more existential as to whether you invest in the product or not. In sort of early growth, it's a little less existential. The key there is you've always got to kind of sleep with one eye open, keep watching the competition, make sure no one's ever coming up behind you or going to overtake you or leapfrog you. And so you're monitoring that. But you're also really listening to the market because you need happy customers, you need low churn, you need high customer satisfaction. That's the lifeblood of any company. So each company is a little different. I can tell you some of our companies have invested, millions in product post-investment. And that was the right thing to do. And some of our companies have hardly invested at all in product. And that's because their product was pretty robust to begin with. So there's no one size fits all on it. If your product needs a lot of product architecture and improvements and a rewrite of the tech, and that to me is product risk, and that's not suitable for Iron Gate's LP base.
Well, the other dilemma that comes up is the managing by numbers or managing by KPIs. I've had people come and tell me you should metric everything, and then it can be completely confusing because you have so many numbers you don't know which one to look at. And so how do you trade off between measuring by numbers and then measuring everything with the idea that, well, if I can't measure it, I cannot manage it? And so, but at some point there's got to be some selection criteria. Otherwise the paralysis of analysis sets in.
It does. Metrics are helpful to a point. It is interpreting the numbers, sort of reading the tea leaves, so to speak, right? I'm from South Africa originally, and a witch doctor in South Africa would be called a sangoma, and they would throw the bones, and you would go to them for a prediction on your life or your wealth or your health or whatever it is. And to me, I sort of think about it that way a little bit, which is, okay, present me the KPIs, but what are we seeing in the KPIs? What are they telling us? And then how do we react to that? That's where real business acumen comes to the fore. Measuring something is not really that interesting. It's being able to react to the numbers and predict from the numbers. And so those are the kinds of executive teams that we like to work with, where we sort of having very robust and interesting conversations around what are we seeing in the numbers. Is gross margin going down? Now, why is that? Should we be worried about it? Should we not? Is that actually investment into growth in the future? That kind of thing. I think to win in any position in any industry, frankly, it doesn't matter if you're a chef in a kitchen or, a venture capitalist or, you name it. To me, I think it comes down to three things. It comes down to being able to spot a gap, which is sort of opportunity identification, run the numbers. Is it worth pursuing that opportunity? And selling. And selling isn't sort of the buy one, get one free tactics of marketing. It's much more sort of, hey, Hall, I've thought of an opportunity for your audience or for this or whatever it is. If you invest 20 grand here, this is what it will do. We should hire this person over this person. It's the tactics of then executing, of going through the gap. And that's what we encourage our teams to do, is to sort of look at the KPIs, read them, and then give us an analysis on, is there an opportunity or not? And what should we do to pursue it?
Well, that's very interesting. I've heard quite a number of investment groups talk about the ability to sell, not just the customer, but the team, plus the investors, and all the other stakeholders. The ability to sell is one of the key criteria, one of the most common denominators among what people look for in a CEO. And it appears that that's true here as well.
It is. Let's think about that man or woman sitting in that CEO seat, okay, if she would like to hire a star executive away from some other industry, she's going to have to pitch that person. If she wants to raise capital, she's going to have to sell the longevity and growth and success of her business. If she wants to maintain morale of the troops through a difficult quarter, she's going to have to speak to them in a way that, frankly, is a form of selling. And, oftentimes your best CEOs are going to be proficient at that skill. They're often closing big deals or swooping in to make large customers happy, or managing through kind of a whoops in the business. A software update didn't go well and customers are now unhappy or whatever it is. And so it is a critical skill set. And I think to me that's important at a CEO level, but I think it's important across the C-suite. Frankly, CFOs who have that capability, they are able to secure debt at lower cost of capital. They're able to be a good partner into the CEO around board governance and communication. And so I think it's true across the C-suite.
That's great. That's great. Well, in the final minutes we have here, what else do you think is the critical factor in being successful at this stage of the company's life?
Boy, if you really break it down, we kind of look at it as having a tight plan for revenue velocity, having a world-class and robust finance function, having a engaged, I'm going to use the word warm, but sort of a kind of soft word on it, but kind of a warm and engaged governance structure, a board that's leaning in and helping, and then having a CEO that is willing to engage from a partner standpoint with their capital partners. You put those things together, and you have a greater chance of turning a 3x into a 5x or a 5x into an 8x in terms of return of investment, which obviously helps everyone around the table, including the founders.
If you can do all of that, that's a tremendous company. That's a tremendous portfolio for sure.
It is. Look, nobody's perfect, and there are areas of our business we obviously keep working on to improve. We're proud of the fact that all of our tech investments in our portfolio, they're all leaders in their category, and they're all growing. I think I just looked at the last numbers. The average growth across the portfolio in the last year was 68% year over year.
Wow.
And all of our companies are right at cash flow break even and flying. So we're quite happy.
That's great. So what's the best way for people to get in touch with you? Through the website or some other way?
I'm happy to give out my email. It's ryan@irongatecapital.com. And people are welcome to reach out to us if they're investors interested in sort of joining our group and understanding how they might invest through our platform, and if it's entrepreneurs who are looking for our kind of capital to get around their business. We'll happily take calls from either.
That's great. Well, I appreciate you taking time to join us today and hope to have you back soon for more details. It sounds like a great model you have there.
Thanks, Hall. I really appreciate it. Thanks for taking time to reach out to us.
Thank you.